Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. Today we are discussing the impact COVID-19 has on the real estate assets, development projects, and investors, and what to expect the months ahead. We are also going to touch base on tax changes and other relief available for the owners and operators of various real estate asset classes. So today I'd like to welcome Carrie Heyman, George Kratitis, and Tony Halata from CLA. So welcome to the three of you. So Carrie is a principal in our Century City office, and he provides accounting, assurance, tax, and consulting services to our real estate industry owners, operators, family offices, developers, and syndicators. We are thrilled to have you, Carrie. George is a principal joining us from Plymouth Meeting Office, and he devotes most of his time serving clients in real estate and private equity industries. Again, welcome to the show, George.
Thank you, Leslie.
And last but not least, we have Tony Halata, who is the managing principal in Minneapolis with CLA Wealth Advisors, and Tony is also a member of our private investment committee. So again, a warm welcome to the three of you.
Thank you.
We have some housekeeping to cover, as well as a few PPP updates before we dive into our topic today. And I'll start with the housekeeping. Again, we appreciate your questions and commentary that continues to come through to us via our live stream inbox. Continue to be part of that dialogue with us today at livestream@claconnect.com. We have Jack Rybicki and Jen Rowan, among many other amazing CLA family members, in that inbox, and they are available and ready to respond to your questions. And again, as a friendly reminder, you can always contact us for program tools and other developments related to specific consultation at claconnect.com on our COVID-19 landing page, and you can use that contact us button. So with regard to PPP, as you know, we have been tracking very closely all of the legislative proposals in the House and Senate, and we do anticipate that in the next couple weeks that we're going to be doing a deep dive in legislation around what's unveiled. Today, however, what we do want to cover with you is some FAQs that were dropped Tuesday of this week. So, as with most FAQs, they were great because they did answer many questions for us. But as with a lot of questions that are answered, of course, we also create a lot of new questions. So let's start with what we do know now, and then we'll also talk about what some of the unknowns are still. So here's some of the good news, what we do know. With respect to timing, the good news is that for payroll and non-payroll related costs that were incurred before, but paid during the covered period, those costs should be eligible for forgiveness. Great news. With respect to group healthcare benefits, that seems to have greater flexibility, which is also positive. However, prepayments of group health insurance benefits are not going to be allowed. Downside. Sticking with prepayments for just a moment, that FAQ also clarified that prepayments for employer contributions for retirement plan benefits are also not allowed. With respect to allowable costs, we also got some great guidance. So mortgage payments mortgage interest rather, seemed to be a broad category where we got some much needed clarifications. The FAQs provided that payments of interest for business mortgages on both real and personal property, so think auto loans, for example, are eligible for loan forgiveness. That said, and this is important to note, interest on unsecured credit is not eligible for loan forgiveness. And that makes sense if you think about it, because really a mortgage implies that there's some element of collateral and security associated with that. Also related to eligible costs, I know we had for the longest time everybody wondering, what does it mean when we talk about transportation? Well, wait no more. We finally got guidance on that. And the guidance was a little bit disappointing. So transportation is very limited to being defined as service for the distribution of transportation. And what that basically refers to is transportation utility fees that were assessed by state and local governments. So unfortunately, what that seems to indicate is that it excludes something like gas for company vehicles. The last area that we got some really good clarification around is forgiveness reductions. So when we talk about that wage reduction test, we got some really good guidance that seems to only apply to decreases related to salaries or wages. And this is good news because it doesn't seem to penalize situations where we've got decreases related to commissions and bonuses, which was a big concern for people this year because obviously there's a lot of people not earning those. So all in, a lot of good clarity that's been provided. Now, again, FAQs create clarity, but they also create some more questions. So we're still left with some big items that need to be addressed. First of all, how should borrowers apply before the end of the covered period? So when you think about that particular issue, if you apply before the end of the covered period, how do you cap that cash compensation, and should you modify that if you apply early? And then also, how do you modify those documentation requirements if you're applying before the end of the covered period? So those are some things that they still have to address for us. Also, there's still some questions around 3 particular certifications that the SBA needs to address. So the first one relates to reviewing the economic necessity for loans that are over $2 million. Secondly, there's a Form 3508 certification. This particular certification states that the dollar amount for which forgiveness is requested is used to pay costs that are eligible for forgiveness to retain employees. And we don't exactly know what are payroll costs to retain employees. So we're going to need a little bit more guidance on that definition. And finally, we need a little bit more clarification on how the SBA will review the FTE reduction Safe Harbor 1 related to a reduction in the level of business activity. The final area that we still are waiting clarification on, again, I talked a little bit about how we got a lot of good guidance on prepayments, but what's still unclear is whether or not prepayments related to payroll costs, rent, and utilities are going to be eligible for forgiveness. So we have summarized all of this great information in an article. It's out at claconnect.com on our COVID-19 landing page, and we encourage you to read it, check it out, and contact your CLA advisor with questions. So with that, I'd now like to pivot our discussion over to the real estate topic, and I'm going to welcome Tony to the conversation. So hi, Tony, welcome to our live stream. And I'd love to kick off our conversation with some general insights into the impact that we've seen by asset class.
Great. Thanks, Leslie. Appreciate the introduction and good to be with everyone today. I really wanted to break it down into really 3 categories of real estate because I think there's a very different activity that we're seeing in economics in these different sectors. So the first bucket I would put in is a troubled bucket, which is hotel and retail commercial real estate. The second bucket I would put in is multifamily residential apartments and industrial properties. And the third I want to talk to, because we all live in a dwelling, most of us own a home, I want to talk just briefly about residential, even though it's not in that commercial bucket. And single family rental is getting to be a big asset class, but it's been an interesting year. Historically, commercial real estate's been one of the most stable asset classes over time. It's something that has provided great stability and income for investors over long periods of time and very high risk adjusted returns, but it's never been thrown a curveball like we've had this year with COVID. And so this has been a very interesting period, and I think it is going to have long-term impacts, but there's also some short-term impacts, and I'll talk more about that. But let's talk about the first phase. And one of the things I want to share is that CLA has over 1,000 real estate developers and operators as clients. I'm involved in working with many of them, along with our CPAs that serve them. And then also we invest over $1 billion of our clients' money into have invested into commercial real estate as well. So we're living that world every day, and we're getting a lot of feedback every day. So this is kind of good data that we're getting, that we're not just reading about, but that we're living and hearing from our clients. But on the hotel and retail side, one of our clients on the hotel side, who's a very good client and one of the best, we think one of the better commercial real estate operators in the country, has shared with us that he thinks the damage in the hotel industry this year is going to be like adding 9/11 to the 2008 financial crisis and take it times 10. That's how bad this is for the hotel industry. There's a lot of surveys showing that 25% of all hotels in New York City are going to be shuttered and will never reopen. Now, the good thing about a recession or a downturn like this is it rids you of poor performers, maybe some product or businesses that should not have been in business in the first place. And when you come out of this, the survivors do extremely well. So that'll be the positive on the other side of this. The good thing about hospitality is before we went into this downturn, hospitality was doing very well. Millennials were traveling like crazy. Business travel was up. Occupancy and ADR was up. So we believe that hotel is going to be a great distressed play for that reason. And so we're going to be working on some distressed hotel opportunities. But there's going to be a lot of hotels that are going to go through bankruptcies. Every day we're hearing about keys that are getting turned in from the owners to the banks. So this is going to be a process that's going to take 24 months to work through, we believe, pending that we get a vaccine. And that is going to be a big game changer for the industry and travel in general, is if we get a vaccine and people are comfortable. I think business travel probably is going to come back to any kind of sizable level until early next year. And so hotels depend heavily on that business travel as well. So hotel is going to be short-term pain, but we think long-term gain. Retail was already struggling before this, and this is going to be, you're going to probably see a lot of retail and malls get repurposed, being turned into distribution centers, things like this. There's going to be retail that probably should have died a while ago that will finally die and be repurposed. And that's going to be a positive for those properties. And then on the positive side, apartments have fared pretty well. Now you could say, well, because of the unemployment and some of the benefits in PPP that help businesses stay afloat, that help people have the ability to pay their rents. But rent collections have been surprisingly strong, running about 93 to 95% nationally. Normally they run about 98%. So they've been pretty good. There are some people that are concerned about as we go into the fall, and if these unemployment checks don't continue, and we'll see what Congress comes out with here this week. They're talking right now about extending the $600 a week or cutting that. That'll have some impact on rent collections. But overall, we went into this with a shortage of affordable housing. We like housing long term, and we think housing is going to fare well coming through that. Industrial's been just on fire, and apartments, in a good way, it's been really strong. And right now, big institutions are interested in investing in this uncertain time in industrial because of online shopping and e-commerce, benefiting from this downturn. So last mile industrial is very strong and rents are growing. So there's big institutions that want to invest today in industrial, and they'll invest in multifamily. Those are being viewed as safe asset classes right now, and it's kind of considered the safe trade. The last thing I want to end it on is residential housing. I think a lot of people, what's very different about this downturn than 2008 is that one of the most important things to people and their confidence is their home. If they own a home, it's their job and their home. In 2008, people lost jobs and they had their houses going down in value, or maybe lost their home. This time, homes are going up in value. And so we have a shortage of supply in many markets. Home prices are going up. The high-end market has been soft. If you're over, $1 million or $2 million, that market is soft. But anything, under 500,000 in any major market is extremely strong, and home prices are going up. And that's going to help a lot of people survive this, get through it, and provide confidence to them.
Well, that was a really great breakdown by segment. And maybe what you can do is also tell us a little bit more about what that maybe means for current development projects.
Hey, Leslie, yeah. Could I interject a second? I just want to add to what Tony said on the asset classes, Absolutely. If you don't mind. Yeah, so I just wanted to say that in addition to what Tony spoke about with the various asset classes, commercial office right now is kind of an enigma. I mean, commercial office is sitting there, and for the most part, you haven't seen much stress on the rent side because, most companies are paying their rent, especially credit tenants are keeping up with their rent. But what you're going to start to see as we get into next year and 2022 is a lot of these leases are coming to term. And this is going to be very interesting as to what companies are going to do now after this big experiment that we've had being COVID-19 and all the remote working that's taking place.
Yeah.
Some of our clients feel that the top quality commercial office is going to do fine, but perhaps some of the lower grade product that's out there might not do so well, might have to be repurposed perhaps into some other type of real estate. So I just wanted to kind of add that perspective on commercial office. Tony, back to you.
Yeah, well, thank you, George, for bringing it up. And I apologize for not discussing office because that is probably the area that's the most controversial right now. The positive with the office sector is there's been very little new construction over the last decade. So that's the positive. The concern right now is obviously this work from home and whether people are going to be bringing people back to work. Our belief is that people are going to come back to the office. A lot of these leases are very long term. We're a very large tenant ourselves. We have 120 offices around the country. Many of those leases are 5 or 10 years in length. We're not going anywhere anytime soon. So I think that's going to help stabilize the office industry. And I think this is overblown that everybody's going to start working from home. We believe that culture is king in running an organization, and it's very difficult to drive culture and productivity with everybody working remote. So we think it's going to be a combination of people working in and out of the office will be the future, not totally from home.
Makes sense.
Yeah.
So in terms of just talking again about the current developments, is there anything else, Tony, that you would think about as we think about current development projects?
Yeah. Well, the market really changed here. Obviously, when you have disruptions like this and crises, it impacts the capital markets. The capital markets are the lifeblood to real estate, right? Real estate depends on a lot of capital, right? It depends on loans and debt, and it depends on equity investments from investors. What happened is there was tremendous demand and interest by banks, insurance companies on the lending side before COVID. Investors were lined up and willing to fund projects. It was really strong. And when COVID hit, everything stopped. I mean, it stopped for about 90 days. Pens went down. We had several projects we were working on funding for our clients, and we just stayed in touch with investors. Some of those investors have come back, and some went back and had to put out. Some of these big real estate groups said, I got to take care of my portfolio right now. I don't have time to invest in new deals. And they've just kind of hunkered down and are trying to manage their risk right now. And there's other investors that have capital that they need to put to work. And so in May, we started seeing things start to thaw. But even banks stepped away, where Wells Fargo and some of the big banks totally stepped out of the market for 60 to 90 days. Wells Fargo is the largest commercial lender in the country. And so when you get big banks like that step away, it gets very challenging to get financing put in place. So the good news is we think the banks and the insurance companies are going to start to come back, and we're already seeing that start to happen. We are seeing investors on the equity side willing to come back now, and we're starting to raise capital again. And so people are coming back and gaining confidence. And I would say on the positive side, on the debt side, what's really strong and an incredible opportunity right now is interest rates. The U.S. Treasury bonds are hitting record lows right now as we speak. We're at 49 basis points on the 10-year Treasury right now. And you say, well, why shouldn't bank loans be lower? Well, banks are widening their spreads because of risk right now. They're not bringing their rates down on lending right now. They're actually widening them out. But the government, Fannie Mae, Freddie Mac, and HUD are big lenders to commercial real estate, especially affordable housing. We were quoted yesterday 80% loan to value on a multifamily project that stabilized, a 2.7% rate fixed for 10 years on a 30-year amortization. So money is really cheap from an agency perspective. So anybody that's on this call that has multifamily properties, there's some incredible opportunities to refinance and take advantage of this extremely cheap money that's non-recourse. So again, we think things are picking up. The other thing is the Fed has injected more capital into the markets. M2 money supply, it spiked to an all-time high here recently. What the Fed has done is injecting massive liquidity into the system. That's why you're seeing the stock market move up like this. I think the third and fourth quarter could surprise people just how strong the capital markets and how strong investing is going to come back and confidence is restored with what's happening right now. And again, a vaccine would make a big difference.
Well, Tony, these have been wonderful insights, and we really appreciate you joining us today. With that, we're going to pivot our discussion now to a couple relevant tax topics. And I want to start with you, Carrie, and talk just for a moment about a couple of the recent developments that have happened. We'll start with the CARES Act and the development around qualified improvement property, if you wouldn't mind giving us some background on that.
Sure. Thank you, Leslie. A pleasure being here today. As we know, we've been talking about it for a while. The Tax Cuts and Jobs Act of 2017 contained a glitch with regard to qualified improvement property, which instead of it being a 15-year depreciable life, it then became a 39-year depreciable life, and these assets were no longer eligible for federal bonus depreciation. Thankfully, the CARES Act came along in March of this year and provided a fix to that glitch. So now we're able to go retroactively to the 2018 and 2019 tax years to go back and claim that loss, so to speak, from the TCJA of 2017. So how do you do that? There's two ways to do that, lots of planning opportunities. One is an amended tax return for either 2018 or 2019. The other option is a application for a change in accounting method, which is called the Form 3115 in the business. I've done a bunch so far this year. Pretty quick analysis that we can do and huge tax savings to our clients.
Thank you for that, Carrie. And certainly when we're doing that, we have to also analyze the interplay of that with a lot of other tax benefits. And so, George, I'd love you to also comment on Code Section 163J, which for everybody else, what that really means is interest expense limitations. We just had 575 pages of regulations released last week, so pretty short and easy reading. But obviously that interplays very well with QIP, and so maybe you can just discuss the interplay of those two and considerations one might think about.
Sure, Leslie. We'll absolutely. So 163J, as you described, is the code section that put a limitation on business interest expense deductions for certain taxpayers that didn't meet an exclusion. And that was pegged at 30% of adjusted taxable income. But the CARES Act came in and said, let's give some relief. And what they did is they bumped that up to 50%. And they did that retroactively for 2019 as well as 2020. A lot of real estate companies, however, back when this was enacted from the Tax Cuts Act of 2017, had an election that they could make, which was the real property trader business election, to get them out of that limitation so they didn't have to worry about it at all. And in return for that, they had to use ADS depreciation instead of makers and lengthen the depreciable lives of their real property assets. Well, the opportunity right now is the fact that since the CARES Act moved the limit to 50%, if we have real estate companies out there that made that real property trader business election, they have the ability, well, one of the things they gave up in doing that also was the qualified improvement property that Carrie just spoke about. So they couldn't bonus this qualified improvement property that because it came after the election that they would have made. One of the things that they can do now is if they can go back and do a little arithmetic and figure out that they, if they went back to the old method, they wouldn't exceed the new 50% limit, they can undo their election and they will be able to go back and retroactively take bonus depreciation on any QIP or qualified improvement property that they might have placed in service. So that's something that is still available out there, and they need to talk to their CLA advisor about that if that is an opportunity that they think might apply to them.
Yeah, and Carrie, maybe you can bring this full circle, because certainly while we've got the ability to weigh those options, there's also this whole new picture and opportunity with net operating loss carryback. So walk us through the highlight of that really quick.
Sure. You can probably sense a theme by this. Following the 2017 tax reform, NOLs generated for the tax years ending after December 31st, 2017 could not be carried back. So then comes the CARES Act, our lifeblood, I guess you can say, for this call. And NOLs from 2018, 2019, and 2020 could be carried back for 5 years, carrying back the earliest year first. Don't want to harp on this too much, but two planning notes that present themselves here. You can elect to waive the carryback, depending on your position. And then the NOL carrybacks also present the opportunity to do some analysis, because the difference between the corporate tax rates pre-tax reform, post with the CARES post-tax reform, really lends itself to finding some great opportunities to save our clients money. And if I just could lastly plug, George brought it up briefly, between QIP, 163J, NOL carrybacks, we have a great resources page on CLAconnect.com. I highly recommend that all of our viewers check that out. A lot more information is available there than what we're covering right now.
No, I think that is fantastic. And with that, I think what we should also talk about is There was also even more guidance, it is hard to believe, that was released on carried interest this week, and it has a lot of applicability to real estate. That said, let's weave that into the discussion that we're going to have on the Biden tax platform, because there are some things in there that could potentially change carried interest. And I think a lot of our viewers might be curious about what that looks like. So Carrie and George, I'd love you guys to talk about what are some of the highlights of the Biden tax platform, and then weave that in with carried interest as well.
Sure. Carrie, you want to start with or you want me to talk about carried interest first?
Kill the messenger first. No, let's talk about carried interest first, George, please.
All right. So carried interest, as a result of the Tax Cuts Act, again, of 2017, that act added Section 1061. Section 1061 basically addressed the fact that historically fund managers in hedge funds and private equity funds and real estate funds, many times they would take a profits interest assigned to them, and they would get that for services performed. But as long as they held that interest, and along with any underlying property for greater than a year, they would get long-term capital gain treatment as opposed to ordinary income. Well, the politicians have been for many years now, been talking about carried interest and trying to do something about it. So the change that 1061 brought about was that you'd have to have a 3-year holding period of such an applicable partnership interest to be able to get the long-term capital gain treatment. On July 31st, we got 165 some pages of the proposed regulations that finally came out on 1061. And the proposed regulations are pretty complex, but they clarify a few things. They clarified that an applicable partnership interest that's subject to recharacterization is not one that's issued in connection with a capital contribution. So if you have a sponsor, a general partner, a fund manager that also makes an investment side by side with limited partners, the capital part of the interest is not considered an applicable partnership interest for purposes of recharacterization 1061. The regulations also clarified that C corporations are excluded, but S corporations are not. The regulations have been and continue to be very favorable to the real estate industry, because Section 1231 gains are accepted from the recharacterization. And then the regulations go on to talk about a litany of complicated related party rules when one wants to assign a partnership interest, a profits interest to a related party, as well as a lot of complicated reporting requirements that are now required under carried interest scenarios.
So that was helpful, and I know that it's going to be covered a little bit in this Biden tax platform discussion, and it's hard to believe the election's coming up, November 3rd, big day looming. What can you tell us, Carrie, about what tax reform might look like if we have a change in regime?
Well, I would say get your DeLorean and go back in time a couple of years, because it sure sounds like Joe Biden wants to get rid of the TCJA Act from 2017. We're probably looking at definite increases in the U.S. individual tax rate. We're looking at increase in the corporate tax rate. So right now for the individual, you're looking at 37% at the highest tax bracket. We're looking to go back to 39.6% under Biden's plan. For corporate taxes, currently at 21%. We're looking at 28% again, with a 15% minimum book tax on companies with over 100 million in U.S. federal income taxes. So there's going to be some changes there. Looking again specifically at real estate, we're talking about depreciation, looking to make some changes to depreciation. The qualified business income deduction is probably off the table. That 20%, up to 20% deduction available to real estate investors. We're also looking at possible changes to the estate tax, which should not come as a surprise. We're looking at possible changes to the ability to step up your basis on death or transfer of interest, or sale of interest, I should say. George already hit on the carried interest. Actually, Donald Trump has been looking to make changes there too. So that's kind of a bipartisan approach to how the rules surrounding carried interest are going to be changed. There's been a lot of talk lately about Biden's proposed elimination of Section 1031 exchanges. And if I could just take a moment to bring that up, there's nothing out there that really substantiates what Joe Biden may have said or did not say on Section 1031 exchanges. What I'd like to say is it's a great way to add additional revenue to the government. It's a great way to kind of to feed into the social programs that Joe Biden's looking to implement should he be elected in November. The key takeaway for me on the Section 1031 exchanges is this is nothing new. In 2017, when we were talking Tax Cuts and Jobs Act, there were Republican House members that were looking to eliminate the 1031 exchange. They ended up settling on the elimination of personal property with respect to 1031 exchanges. That's the current environment we're acting in now. But it shouldn't come as a surprise that Biden or any politician is looking to eliminate something like this 1031 exchange to get more revenue in the government's pocket. Lastly, the only thing I was going to bring up, and as a wonderful resident of the state of California, is I really want my state and local income tax deduction back. That's a limit to $10,000 for federal tax purposes. In California, this wonderful state, I pay a sunshine tax. My friends in Florida don't, but I pay a sunshine tax, and therefore I'm limited to my $10,000. So that's definitely on the table. I think it's going to be a fun next 100 days, Leslie.
Well, we appreciate those updates.
Leslie, can I also add to Carrie that in the Biden plan, there is what we're kind of pretty happy about, an augmentation to the opportunity zone rules. Because CLA and our real estate group has been really a leader in this area, both on the compliance side as well as on the capital raise side, as Tony can attest to. And it's good to see that there's not an elimination or of at least in the proposal from Biden on those rules, but an augmentation to sort of require some more reporting that social good is being done and things like that. So we're kind of at least excited about that won't be taken away.
That is exciting news. Well, I really appreciate all three of you joining us today. You guys provided a ton of fantastic information. I also want to thank all of our moderators who are manning the inbox, and to all of our audience members for all of your wonderful questions and engagement with us. We encourage all of you to continue to reach out to us through our live stream inbox and to continue to contact us via claconnect.com. Again, as a reminder, in the coming weeks, we do plan to extend our session time to 1 hour to unpack various elements of proposed legislation as soon as it becomes finalized. And until then, we look forward to seeing you next Thursday, but please continue to stay safe and healthy and have a wonderful weekend. Thank you so much.
Thank you, everybody.
Thank you.
Sorry about the cut-ins, but